That's the power of investing in an area you trust. We always say location is the number one thing. You can change the countertops and change the cabinets, can't change the location. In this video, I'm going to tell you why my wife and I personally love investing in Detroit, Michigan. We own 131 rental properties that we also operate here in Metro Detroit, Michigan. And I'm a big believer that if you're out of state, if you're from California, if you're from Texas, if you're from Las Vegas, you should consider investing in Michigan as well, in the Metro Detroit area. In this video, I'm going to tell you why we do it and why you should consider it as well.
So Tony, I think for you, one of the biggest advantages is the home field advantage, right?
Let me clarify. When I say Detroit, Michigan, I don't mean like downtown Detroit. I personally don't invest in downtown Detroit. When we say Detroit, we mean Metro Detroit, Michigan. Within, what is Metro Detroit even?
It's huge. I don't know.
Yeah, like 45 minutes, within 45 minutes of Detroit, Michigan. I personally love investing in Metro Detroit, Michigan for numerous reasons. I'm going to give you several here, and I'm going to try to persuade you to consider it. At the time of filming this, Bigger Pockets named Detroit, Michigan, which includes Metro Detroit, as one of the top markets to watch in 2024 and the top markets to invest in 2024. So Bigger Pockets is behind us when we say this, okay? For me, first thing I loved about it was home field advantage. Real estate investing is scary if you don't come from a real estate background. I'm a registered dietitian. My wife was a school teacher. She's now runs a property management business of our own, runs 131 units, and is a licensed real estate broker and has a team of agents underneath her. But we don't come from real estate. So it was scary thinking about investing into real estate. I mean, growing up, we almost lost our home to Chapter 7 bankruptcy. So no one in my family was like, I'm this big real estate mogul. It was scary. So how do we reduce the anxiety? We look for low-hanging fruits. And anything you do, how do I reduce the anxiety? I look for a low-hanging fruit. What's low-hanging fruit? It's easier for me to invest in my backyard, places I know, versus out of state. Because everyone's like, go invest where it's warm. Go invest in Florida. I don't know anything about Florida. Besides that, there's alligators and swamp creatures, and it's hot and humid, and Palm Beach is nice, but I probably can't afford to invest in Palm Beach. Texas is crazy with property taxes, which we'll talk about in a minute. So my first apartment deal hit the MLS. It was listed for $550,000. I paid $660,000 for that apartment deal. Nick, am I stupid? Why would I do that?
Because you could increase the value and make it more profitable.
And because I knew the area. Nick's got a very beautiful studio that we're filming in here. It's 5 minutes from here. This is a wealthy, affluent area. The apartment's 5 minutes from here. I knew that road. I knew what was around there. I went and drove it. I'm like, Ange, with my wife, Andrea, get in the car. Let's go drive this property. We got out. Nick, you've been there. Remember what's across the street from our 7 unit?
Mansions.
Multi-million-dollar mansion. The beautiful Bellagio estates. Beautiful custom homes, big, beautiful homes. I looked at Andrea. I said, we got to buy it. It was listed for $550,000. If this was back when debt was, I still have a 3.9% interest rate on it. So debt was low, so prices were wild. We paid $660 for it. The rents were $700 a month. We came in. We fixed the property up. We put in new plank flooring. We put in new appliances. We spent about $3,000 per unit. So nothing crazy. We used the cash flow that property was producing, put the money back into it. We didn't try to just take the cash flow. We reinvested the profits back into the business because apartments are treated like businesses. Single family homes are not. Single family homes are based on comparable sales. If I own a house and my house is 10 times nicer than the one down the street, but the one down the street sold for $200,000 and I'm asking for $500,000, the appraiser is going to look at that comparable sale. Apartments go off of NOI, net operating income. I saw the rents. I knew they were too low. We fixed up the units. We got the rents to $1,100 back then. Today they rent for $1,250. My NOI went from $30,000 to $60,000. And if you remember, if you watched my content, you know the magic formula is NOI divided by cap rate equals valuation. So $30,000 to $60,000, NOI is my net operating income. It's profit minus expenses. $60,000 was my profit divided by a 6% cap rate, which is what it appraised for. That building appraised for $1 million. I paid $660. I put $132,000 down at $660. Where did I get the money from? I had a business. I built a business first and I saved my money. That's where. Went back to the bank, $1 million. Did a cash out refinance at 75% of that, $750,000. I only owed, I forget how much I owed at that time. I was able to walk away with $250,000, a check at closing for $250,000 tax-free. I didn't have to pay tax on it because it was new debt. My $132,000 turned into $250,000. A year later, I still own the property. Still cash flows. That's the power of investing in an area you know. If I didn't know the area, how could I have been so bold to overpay. I can't tell you how many people said, you're stupid, you're overpaying, it's too much. Now that property is probably worth 1.1, 1.2 million. And I still have a 3.9% dent. Sometimes, because we've posted about this before, we've done a full video on this property. If you want to go learn, go watch that full video on my 7 unit. People say, but you have to pay the money back. No, I don't. I don't pay anything back. The property pays that money back. And what's my return on investment? I put 132 in, I pulled 250 out. I still have it. It still cash flows. It pays all the bills, including the mortgages. What's my return on investment? Infinite, because I have no money in the deal. That's the power of investing in an area you trust. We always say location is the #1 thing. You can change the countertops, change the cabinets, can't change the location. So why I think you should consider Michigan, even if you don't know the locations, because we have good spots like that are very affordable. People too, they'll comment on when we talk about this, they'll say, I can't even buy a shack in New York for $660. No one told you to live in New York. And I'm not telling you, I don't live in New York. That's Michigan. That was what, $90K a unit back then? That's Michigan. It's more affordable. It leads me to my next point. It's more affordable. And if you have any question about what we just talked about, leave a comment below. But it's more affordable here. We still have nice areas. We still have good, clean, safe areas. Again, I'm not talking about like inner city Detroit here. That's extremely affordable, but still affordable compared to the Texas, compared to the San Diego, where things are 400 grand a unit, 500 grand a unit. The barrier to entry is so much higher. Michigan's very affordable. My last deal I did was 56 units. I paid north of 80K a door for it. It's a great area, right by a Starbucks, GM Tech Center, General Motors, US military installation, TACOM, huge shopping centers. It's great area. 80K a door. So don't hate it because you ain't it. Don't hate the player, hate the game. If your area is 200 grand, 250 grand for new construction, you can't get into it, or for Class C product, you can't get into it. Think about Michigan. It's affordable. My next point, we get solid appreciation. Now, I'm not going to get 30% year-over-year rent growth. We don't get that like Austin, Texas or whatever. But what happened in the pandemic? Go look at all the charts. Austin, Texas, Las Vegas, Nevada, West Palm Beach, Florida. They shot up 20, 30% year-over-year rent growth. Everyone flooded the money there. Then what happened? Whoop, rent concessions. Michigan, through the pandemic, through everything, has posted positive, and Detroit, Michigan, Metro Detroit, Michigan, has posted positive year-over-year rent growth. We have not, and I can tell you as a operator, again, I'm not just an investor and I say, here you go, property manager, take the keys. We own and operate, and in our brokerage, we help other investors. We work with a lot of out-of-state investors get into rental properties here in Michigan because we own a brokerage. I've never given rent concessions, meaning I've had to lower the rents to get people in, or give a free month, or give like a TV away. I don't do that. I don't do that stuff. Now, it might be a little bit of appreciation, 3%, 5%, but that's all good in my book because I'm not going backwards. I wouldn't want to be in a market where rents shoot up, then you get so many people coming there, so much new supply. Remember this, cranes in the air, beware. Nick, I was driving to your lovely studio here. I saw a bunch of beautiful older apartment buildings. You know what I didn't see? Bunch of new construction going on. Do you know of a bunch of big 200, 100 unit Class A's going on here in Plymouth, Northville, Novi, Michigan?
Not around here.
Not around here. Like Ann Arbor, you get it, where it's like University of Michigan, Sterling Heights, maybe a little, but it's pretty developed here. It's not like Nevada where you can just go buy big old plots of land in like Summerlin and just like master plan communities come up. This is Michigan, man. Metro Detroit. It was the hub back in the 20, I'm not a history teacher, but it's developed. So we don't have new supply coming in. So that means it's law of supply and demand. There's limited supply, the demand goes up. We don't have this massive new construction. Like I was reading the Bigger Pockets article about how like markets like Austin, Texas has they're expecting 9% rent growth, but they're expecting 10% of total supply in new construction. That's negative for current owners. If you've got 9% growth, but there's 10% new construction coming in, if I own, so let's like talk about my 56 unit. It was built in the 60s, great property. Our market rent there is about $950 for a 1-bedroom, $1,150 for a 2-bedroom. Let's say they build a brand new construction building right next to me, which they can't because there's nowhere to do it. But let's say they did that, and it has a pool. It has a fitness center. It's brand stinking new, and they're charging $1,250 a month. I'm going to lose all day long because people say for a little bit more, I'm going to get so much more. That's the problem. We don't have that in Metro Detroit in the good areas. You cannot go build a 56 unit right next to mine. Not only that, but the replacement cost of that building is $9 million. I'll tell you right now, I paid under $5 million for it. So for someone to come build that today would cost $9 million. To charge $1,200 in rent, it just mathematically doesn't work out. Those are the pros and cons. And again, now Austin, Florida, whatever, you're going to get great appreciation. You are. You're going to get wild appreciation, but you're also going to deal with other factors. New construction, big syndication groups. Like Grant Cardone's not investing in Michigan. He openly says, I don't go where there's snow is. Good for me. Good for me. My friend and mentor, Robert Martinez, he invested in Houston, Texas. Good for me. You know, we obviously have large syndicators here. Gideon Pfeffer, who's been on our show, great guy. Just Larry spoke to him yesterday. He syndicates here, but the little guy, you and I, the little guy, the people who don't come from hedge funds, people who don't come from mommy and daddy writing us a check, people who don't come from mom and dad own 4,000 units. Now we're just taking over. We can get ahead. I come from nothing, zero. We have 131 units. We're 33 years old. My wife and I will probably get to 1,000 units. Majority of those probably will be in Michigan. So pros and cons. And dude, I've been seeing, it's weird. I've been seeing these TikToks and it's like, why I moved to Michigan? And you know, one of the top points is rent's affordable. And it's a nice girl and she's doing a TikTok and she's like, I can rent this beautiful home and it's extremely affordable. Affordable rents. That's what we like because everyone's like, well, when the market crashes, you're going to be in big trouble. No, I'm not. You know who's in big trouble? The Class A, because people move down in a recession. I'm not saying a recession is coming. I don't know. I don't know. People move down in a recession. So my $950 a month is not in trouble. Your $2,500 a month in San Diego, the penthouse in San Diego is in trouble. Not my $950 a month. Where do you go below that? $500? That's like a hobble in Detroit, Michigan. You know what I mean? Like inner city Detroit. So completely agree with that. So again, drawing the comparison, Metro Detroit, right? Everyone's always like, oh, go invest where the money's going. Go invest where. Let's talk about property tax because everyone's like Texas, Florida. Michigan's beautiful with property tax. After a sale occurs, and this is important. If you're a real estate agent in the state of Michigan or you're a real estate investor in Michigan, pay attention to this. When you buy a property, the next year it's uncapped. That means they can raise the valuation to fair market value. So I bought my 56 unit. It last sold in 1993. My taxes are going to uncap this year. We're already prepared because it's been 30 years, probably going to double. Okay. That's part of my underwriting. That's part of my due diligence. I'm aware of it. I'm good. I was just talking to my lawyer yesterday about it. Property tax lawyer. After that, they're locked to only the rate of inflation with a cap of 5% max per year. So it means every year you own it, the max they can go up is an additional 5%. Most years, it's very minimal. I mean, inflation is through the roof right now. So we are like, I just got a lot of my assessments back. We are getting the max 5%, but that's it, 5%. In Texas, there is no cap. And that's where our mentor, Robert Martinez, was telling us all owners in Houston and Texas are getting hammered right now because taxes and insurance are shooting up 30, 40%. That's what's called a fixed cost. That's what's called a cost that you cannot impact. I can lower the utility bills. I can increase the value of the unit. I can make it nicer and increase the rents. I can't change taxes and insurance. It is what it is. Taxes, you can fight it a little bit, but it is what it is. So if you're an operator of an apartment or a rental property and your taxes shoot up 30%, how do you keep pace with that? There's no way your rents went up 30% in a year, unless it's like a total value add, but once it's stabilized, you can't do that. Michigan, we don't have those problems. So again, the grass isn't always greener on the other side. Grass is greener in Michigan. No. Last part here too, I want to touch on the 1% rule is achievable here. Nick, have you heard of the 1% rule? If I can get 1% total gross collected cash, rental income, fees, whatever, 1% of the purchase price, it's a good deal on paper, right? There's obviously a multitude of other factors. So for example, I told you guys, I paid under 5 million for my 56 unit. Let's say I paid 4.5 arbitrarily. We know, what did I just say? Rents are $950 plus $50 bill back for what we call RUBS, ratio utility billing. So we just bill back some of the utilities, and $1,150 plus 50 for the 2-bedroom. So let's just even call it $1,050 across the board. Because if people renew, we don't bring them up to market rent. We give them a discount to renew. $1,050 times 56. So it's $58,800. So let's say I paid $7 million for that property. That doesn't follow the 1% rule. 1%. So if I paid $7 million times 0.001, I'd have to be at $70,000 a month in total gross rent for it to cash flow. It's the old like rule. 1% of purchase price in collected rents cash flow means the deal should cash flow. It's very hard to meet that in some of these areas, but Michigan, we can still meet that 1% rule. Now, I'm not telling you the 1% rule is the golden rule or the only thing to consider or only thing to look at, but it's a good tool that if you can meet that 1% rule, you know it's a good deal. You know you're probably going to cash flow and you know you have, good upside with that. So in Michigan, we still can meet the 1% rule, which I know in a lot of other markets just doesn't happen. So hey, if you found this valuable, if you found this helpful, let me know, leave a comment below. If you have questions about investing in Michigan, let me know. Hey, we own a real estate brokerage here, okay? The Stefan Group Real Estate. My wife runs it. I help support it and I help tell people about it like you. We get a lot of out-of-state investors, people from from California, people from New York, people from all across the country who say, I see what you guys are doing in Michigan. I want part of it. Part of what makes us so different is we own and we operate real estate in Michigan. It's so hard to find a real estate agent who owns a lot of property and operates. So if you're interested in investing in Michigan, if you've been wanting to get into real estate, but it's difficult in your area, you just don't have the time, you don't have the energy, you just aren't sure, and you want to explore the options in Michigan, send me a DM. Click the link in the description here too. You can fill out the expression of interest form on the stephengrouprealestate.com. We'd love to set up a call. We'd love to learn more about you and your goals. One of our team members reach out to you, learn more about you and your goals, see how potentially we can help you get into cash flow producing real estate here in Michigan. All right, so if you enjoyed today's episode, we want to hear from you. We want to get your feedback. I love when we get comments. I love when we get feedback. I hate just doing a video and not hearing from you. So here's what I want you to do. Number one, drop a comment. Did you like it? Did you not like it? What do you want to see more of? What are your thoughts? If you have any questions, put them below. If you notice, guys, I respond to all of my comments personally, and I'm always going to do that. So drop a comment below. Be sure to like the video because it helps us get to more people on YouTube. Be sure to share the video if it's helpful. Please just share it with a friend. That would be a huge value add to us. I have a couple free resources for you. Number one, if you want to learn more about wealth creation, the mindset around wealth, how I went from working in my business, building a business, to investing into real estate, all from starting from scratch with food stamps, Chapter 7 bankruptcy. Get my book. It's called The New Rules to Financial Freedom. It sells for $19 on Amazon, but you can get it for a free digital download by clicking the link in the description. If you want to learn more specifically about real estate investing, the BRRRR strategy, how we've grown our portfolio, I have a free masterclass that people paid $3,000 to come live in person in California to learn in person with me teaching that room, but you can get that masterclass for absolutely free by clicking the link below. Finally, if you want to invest into real estate in Michigan, and maybe you're from Michigan, maybe you're not from Michigan, or you want to learn more about our brokerage, the Stephen Group, and either have joined our team as an agent, invest with real estate, or have us help you get into cash flow producing real estate, click the link below, Stephen Group Real Estate, fill out that quick expression of interest form. Someone on our team will reach out to you, set up a call, learn more about you and your goals, see how we can add value to you. Until our next episode, thank you so much for being here. We'll talk soon.